Hey guys, and welcome back to another video here on the channel. If it is your first time here, my name is Brandon. The topic of today's video, we are going to be covering the big 5 banks, or big 6 banks, I guess whatever you want to categorize it. And in particular, we're going to be covering whether their dividends are safe at the moment. This is a question that we actually got, surprisingly, over on our poll. We have a Facebook page which is completely free for Canadians. If you want to go join that, I'll do the courtesy of linking that down below. But this was the top topic that people wanted to hear about. I take it because banks, kind of across the board, if we look at the options right now, we're seeing some very nice starting yields, up above 5%. These are historically some great dividend payers. They've been growing their dividends. And I know for a lot of us probably watching this, you very well may own a bank stock yourself or be thinking about buying one. I know for a fact I own 2 of the big Canadian banks, and they represent core positions in my portfolio. And a lot of viewers at home, our older viewers, were probably relying on this income for retirement or for whatever the case is. They are outstanding investments. And across the board, we are seeing dividend cuts. This is what comes with a recession. This is what is to be expected when we see business and the economy pretty much come to a standstill. I saw today Husky, for example, slash your dividend by 90%. I'm sure we're going to hear a lot to follow over the coming weeks. And one thing that I think we should make clear before we dive into this is just to understand that we are in a pretty unique time. Not a pretty unique time, a very unique, unprecedented time. We've gone through recessions over and over again in our past, but in terms of a shutdown, a big global lockdown like this, you don't really have too much to look back on. So there's a lot of uncertainty. There's a lot that we're going to find out going forward. But I guess the best thing we can do as investors is kind of look at the facts that we know now and try to make as educated of a decision as possible. Not trying to scare anybody here. I think the banks are going to be just fine when you look at it over the long term. And not to ruin this video and cut to the end, but I think their dividends are going to be fine. But let's take a look at the reasons why I say that. But it is just good to keep in mind, we really don't know. And we'll kind of see how things play out as we go through the next couple months, let's call it, and probably going forward after that. But one thing that I think the bank definitely has working in its favor is the fact that this is considered an essential service relative to some other businesses that have completely gone out of operation. Some are at a complete standstill, and no doubt branches are closing, companies are seeing slowdowns across the board, but a lot of banking services, a lot of what they offer is still operational as we speak today. They're still collecting fees. I know they're being a little bit lenient on things. Another benefit to think about is you take a look at all the government, the money that the government is giving out to us. I know businesses are able to take loans out. I got an email the other day for something to the likes of 40 grand that they're able to lend out. The banks love lending this money out. This is not a bad thing for them because the government subsidizes it. We have to keep in mind that, you know, it may look like they're giving out free money, but it's really the government who's paying the bill at the end of the day. So the banks in and of themselves, they're still operating better than a lot of companies out there. They're happy to issue out loans and do what they can to help spur some economic activity with the government kind of backing them. But there are definitely some downsides that I think are well worth mentioning when it comes to the financial sector right now. One to think about for sure, which goes for pretty much the banks, insurance companies, this kind of goes across the board, but the interest rate, being in a low interest rate environment, which we are in now, this is typically not the most optimal. It's not the best environment or the best situation for the banks. If we just have a quick refresher on how banks work and how they make their money, they're in the business of taking deposits. They take our money in the form of savings accounts. We put them in a savings account. They pay us a little bit, maybe a CD or a GIC of some sort. They take that money and then they reissue it out in the form of mortgages, in the form of car loans, personal loans, all sorts of investments that they can charge a higher interest rate on. When the broader interest rates in general are higher, well, they can be more profitable. There's a higher spread on the money that they can lend out. When we're in an environment like we are right now, it becomes much tighter and is just not as profitable for the banks. Now, that doesn't mean that they can't do well. It doesn't mean that the banks aren't going to make money. It just means that a low interest rate environment is not optimal for them. Of course, on top of that, if we are able to look back a couple months from now, or not a couple months, but a few months from now, and establish that yes, we are officially in a recession, What comes with that is just the confidence. Confidence of the consumer is down. Nobody wants to go out and take on mortgages. Nobody really wants to go out and take on loans to go finance any purchases. That's just what comes with that, which does take a hit on not only the banks, but the entire economy. There's a big trickle-down effect there. So that's kind of what to be expected. I think that's fair to say. Now, what we can do is we can look at the numbers. And I mean, what we're looking at here is the Q1 2020 numbers. So these numbers aren't really showing the full hit of what we have, what we're going to be seeing, but it does give us some grasp of how the company was performing prior to this. I've went as far as highlighting some of the key metrics that I would look at as it pertains to the dividend. In the trailing 12 months, TTM, which let's call it, have been for the most part relatively good other than the tail end, $41 billion in revenue. And by the way, we're looking at TD Bank here in this example, which is one of the two top players here in Canada. $41 billion in revenue. If we take a look at the net income that this company's been able to pull in, $12.26 billion. Dividends. This is obviously an important part. They pay a $2.86 dividend per share. And if we do hover down to the number of shares out there, 1.8 billion shares outstanding. And if you want to do a little bit of quick math, just to kind of grasp how these numbers work together, $2.96 per share, you times that by the shares outstanding, which is 1.8 billion, $5.3 billion is what the company paid out in dividends over the trailing 12 months. We know that the payout ratio by now is the earnings. So the net income right here of 12.3 billion divided by the amount of dividends paid out. So 5.3, which leaves us right around this 44%. That's how they get this number here. So less than half of the company's earnings, they're able to pay out in dividends. And you look back, that's pretty consistent over the past decade. That said, that's when things have been going well. Going forward, again, we do have to wait till the Q2 numbers come out when we do see a slowdown, which they're already expecting in revenue. Obviously, that's going to have an impact on their net income, but is that enough to really jeopardize their dividends? That's the question that we have to ask ourselves. If we see an increase in this payout ratio, if we see a decrease in their net income, is that enough for a company to stop it? Taking a look at the history here, which I think may give us a good answer, at least in my opinion, of what we can expect. This is a list of the top 5 banks and how long they've been paying dividends for. So in all cases, over 100 years, we have BMO paying dividends since 1829. Bank of Nova Scotia has been a dividend payer since 1832. Toronto Dominion Bank since 1857, CIBC since 1868, and Royal Bank since 1870. So some outstanding track records there. In fact, if we want to pop this up, TD Bank, I know I looked at particular for TD Bank just to select one of them. They've actually been growing their dividend at a compound annual growth rate of 11%. Point being is that the banks here in Canada, phenomenal track records when it comes to the dividends. This is why, not only in Canada are they some of the top dividend stocks. If you look at the investment, the scope of investments globally, the Canadian banks do rank up there at some of the premier dividend stocks in the world. And again, it's still too early. There's still a lot of unknowns as to what's going to happen in the coming quarter, but these banks do put a very high priority on keeping the dividends coming. They've made it through the Great Recession. They've made it through the last They made it through the last hundreds. Take a look at this track record. They've made it through number of recessions and downturns, drawdown periods, tough economic times. They make a commitment to the shareholders to do the best that they can to pay out these dividends. It's really why a lot of people invest in the banks. And if I had to put a speculation on it, which again, I never really like to do, I kind of like to just sit back and let things play out. I think that of the stocks out there that do cut their dividends, I'd like to think that the banks are going to be one that is able to hold strong. You guys can leave your thoughts and opinions on that below. This is just my guess here. Again, we still have to wait for the Q2 numbers. We have to wait. There's still so many unknowns that it's hard to say. But of companies out there that would be considering cutting or considering holding off their dividends, I'd probably lean the banks towards being able to sustain their dividends. That said, guys, that is nothing more than me just doing a little bit of research and sharing my opinion here on the channel. Even if these companies were to cut their dividends, which again, is not out of the question. I wouldn't say that's what I'd expect, but it's not out of the question. I don't think it would be out of desperation like some companies. Some companies would be cutting their dividends simply to stay alive. I think the banks, if they do cut their dividends, would be in a precautionary measure, maybe because the government is kind of suggesting that to them. I know for a fact they're holding back on buybacks at the moment. There's still a lot of possibilities as to how things are going to go forward. But guys, I hope you kind of enjoyed my thoughts here. I would love to hear your opinion on this, whether you agree, whether you disagree. You can even just leave a comment with whether you own any of these Canadian bank stocks, and if so, which one's your favorite. My favorite that I own, TD and Royal Bank. We've touched on that on the channel before. That just so happens to be because I bank with both of those. But leave a comment down below. I hope that was a good answer to the question over on the poll over on our Facebook group. Again, a bit of a unique topic. I wasn't really expecting it, but those are kind of my thoughts that I've put together for today. If you enjoyed, feel free to give this one a thumbs up. We post videos here on the channel every week. So if you're new, you can subscribe and hit the bell for notifications. As always, if you want to learn more about the stock market, if you're a beginner and you want to learn more about our Investing Academy, that'll be that first link down below. I'll also actually link the Facebook group if you do want to join. So it'll be down there somewhere below. But regardless, that's a really, really cool training program for anybody that wants help in getting set up, getting their accounts all sorted out, getting a plan structured. We can help you with that. That's our Investing Academy. But as always, guys, I thank you for tuning in. I hope you guys are all staying safe. I hope you enjoyed the video, and I'll see you in the next one.